Mortgage rates are going down. Yeah, old news, we know. My friends, the CMHC has done something they said they were going to do, and that is provide us with a catalog of pre-approved designs for your investment properties. This is what we talk about, all this and more, with our good friend and mortgage broker, Mr. Dion Begg, right after this. Here we are, my friends, back with our favorite mortgage broker in all of the land, Mr. Dion Begg. How you doing, my man?
Hey, Gary. Oh, it's just another day, but every day is different.
Every day is different. It's kind of like Groundhog Day, but better and different and everything else, right? It's all the same news. Is the market going up and down? Is our American friends ruining our economy? All that kind of stuff. But you know what, my friends? As we all know, we all need a place to live with a roof over our heads, and things move on, whether we're in a moving market up or down or sideways, right?
Yeah, people are always moving, and we all need to go to sleep somewhere at night. So housing is important for all of us. It's some
That's
level.
right. That's right. And we all know we could get into and we can peel that onion or open that can of worms of affordable housing and housing for everybody. Well, we'll save that for another webinar here. But the big thing, there's a lot of news coming out. And today we thought we would just kind of dive in on some of the more specific things that perhaps people are making decisions. Should they refinance, renew their mortgage, buy a new home, and what does that do? So we're going to ask Dion kind of our top 5 questions of perhaps what you, the borrower, should be asking. And we're going to share some stats. And one of the things that I'm kind of excited about, Dion, and we talked about this many months ago, is the government of Canada providing a catalog of designs for homeowners and investors just like you and I to go build, and it almost already has the rubber stamp on it, apart from a few things, just like they built homes back in the late 50s and 60s, where if you brought forward this type of design, the local building department would rubber stamp it. So we're gonna circle back to that conversation because some information has just come out. But you sent me some info here, and let's just dive right in, Dion. I'm gonna share my screen here. Talk to us about what we're seeing on screen right now.
Yeah, so this is an extract from a newsletter from a economist, Dr. Sherry Cooper. She's well respected in the mortgage industry. And basically, the article went on to say that, yes, we've had some rate drops. And if you look at the screen here, March 12th was that rate drop that brought us down from 3% down to 2.75 at the Bank of Canada overnight rate. But you can see here 2 more predictions for April 16 and and June 4th, which show 2 more rate drops, 0.25% each, which means that by June, she's predicting that rates will be at around 2.25% at the Bank of Canada rate. What that means is, if this is correct, then those of you listening with a variable rate or maybe getting a variable rate can expect that rate will be down by 50 basis points or 0.5% by summertime. And the reason that she's saying this, Gary, is because, as you and I have discussed, the Canadian economy is not going from strength to strength. We are going the other way. There's a lot of adverse sentiment regarding what's going on with the tariffs. And so for that reason, they believe that there's going to be more downward pressure on interest rates. And as always the case, like, bad news in the economy is good news for interest rate numbers, not that it means that people are going to be excited to borrow money if they think they're going to lose their job.
And we've been talking about this for the last several months, and now we're actually starting to actually see it and feel it in a sense in our own, whether we have lines of credits and that type of thing, because those are the types of products that get affected immediately, as it were, when rates change, not only drop but also go up. I'm curious, as you're speaking with your clients, what's that kind of sentiment right now with the clients that are talking to you? Meaning, are they feeling some good, strong confidence in the mortgage rates and the interest rates that they are that you're providing with them?
Yeah, so I mean, it's funny because we'll only ever talk with people who are interested in getting a mortgage for the most part.
Of course,
And the
yeah.
thing is, what I can say is that we actually are busier now than in the last several years. And I think it's just this culmination of lower interest rates and more properties coming to market. And I know we're going to show some graphs on that later, Gary, but I can tell you that, well, I'll give you anecdotally. Yesterday, I spoke to a client, Stephanie, and we spoke to her a year ago. A year ago, she was looking at selling her property for 1.2 million and upgrading to 1.8 million. And last year, the numbers just became a little too tight for her. Yesterday, we spoke about similar numbers, and because interest rates have dropped by nearly 2%, this is much more achievable and they're actually going to move forward. So, because rates are down, yeah, there will be people who have sort of been waiting and pent up, and like we've had to make this move. And regardless of what's going on in the world, we feel safe. That is, they feel safe in their jobs. Therefore, they're going to move forward. So, there's enough people out there for us and our business to be quite busy right now.
Yeah, interesting. Okay, well, let's jump over to some of those stats. I got them up right now, and we'll share with everybody. This is right off the Toronto Real Estate Board, and we're going to look at a very high level, my friends. So as we all know, we don't buy real estate in the Toronto Real Estate Board. It's very specific to your local community, depending on where you're watching. Whether you're watching here in Vancouver or all the way to the East Coast in Newfoundland, get very specific. However, from Toronto perspective, this is what we're going to be looking at. And this is right off their website. I'm not logged in at any which way. Everyone can get access to this. And the one thing that Dion alluded to here, and I want to highlight as well, is our year-over-year transactions. So February 2024, we're at 5,500 transactions, and that's down to just over 4,000, which on paper, down 27%. That's a quarter. That is a big movement, my friends. And again, a lot of that has to do with, of course, the mortgage industry or what's going on there. Maybe some uncertainty with tariffs and new government leadership, not only in the States, but different leadership here in Canada. The average selling price, as we continue to look at this, is down ever so slightly. You can see here just down 2% year over year. And then the one thing that we really want to highlight too is our total new listings. You can see that up at just over 5%. So remember this. This is for February this year versus last year. Number of sales are down and listings are up, which is going to provide you as a buyer some opportunities. So Dion and I like sharing this type of information for our watchers and listeners because we want to help set expectations, whether you're a seller or a buyer. This helps sets that expectation. And you can see here, days on market is obviously increasing. Well, that makes sense with the higher the higher inventory. And for those that want to look at some of the condo prices, scroll all the way down past the commercial charts here. And I know I'm going fast, but I just want to bring this to highlight this. They do have some condo stats here. And the way that we do condo stats at this perspective is by the quarter. And you can see that the sales are up for the fourth quarter at the end of last year. And we'll get some of that new data. If you want to dive in deeper, you can click into the condo sales report right here, and that'll provide you with some more detailed information. And as you can see here, total listings is all up. My friends, we share this information because we want to make sure that you are in the know. You feel free to reach out to Dion and I if you need some specific community information, but at the very least, you now know where to go do it. Market stats, Toronto market stats, that'll take you right into the TREB website here. Very easy to obtain. And
Gary, you just want to just slide back up to the very top, which shows that February was lower than last year. 27% drop.
Yeah.
Okay. If my little business is a barometer for what's going on, I can tell you my February was low as well, but my January and my March were actually higher. So I wonder if when we look at the March numbers, if they'll actually see an uptick in terms of year-over-year transactions, because that's what I have seen in the month of March already.
You actually bring up a really good point, and I don't want to get too deep into the weeds and technical here, but bear with me, my friends. This stat here, sales, the actual sales stat is a lagging indicator of what's going on in the current market. meaning it gets reported. And as you can see here, we're halfway through March, and these are for homes that sold in February, where a leading indicator, in a sense, would be, okay, what's coming onto market, as it were. And then anecdotally, as Dion just shared, talking to mortgage brokers and even lawyers and such, that could be a leading indicator, because that now you have buyers or sellers preparing of what is to come. So
True.
just remember, sales, the actual sold data, is a lagging indicator of what's going on in the market. And talking to people like Dion, that's why we have Dion on the call every week, so we can kind of help see what's going on from that perspective. So if you need more info on that leading versus lagging indicators, go Google it, give me a ring. We can dive deeper into that. But that's an important aspect, Dion. I'm glad you brought that up, actually.
Yeah, and I think as the weather improves as well, this year in particular, we've had a pretty bad winter, right?
Yes. Yes. Indeed. Okay. Stats is one thing, and Dion and I talked about this. What we're going to zone in on is a housing design catalog. And we talked about this off the top. We talked about this many months ago, where back in the 60s, the government had blueprints for, we've all seen them, those 1960s bungalows with a side entrance, and usually it's a semi or a duplex, depending on where you are in Canada, where the side entrance, you can walk right into the basement, and many people have done so, have turned those into rental suites, and I know I did on a couple of our properties. And they are coming back out with a housing design catalog. So what does this mean? What does this do? Well, if you scroll down here, zone in right on your local province, and we'll choose Ontario. And what they're doing for us is providing, and I forget the number here, approximately 7 models per province of, at the very least, almost that rubber stamp approval. So if we looked at, say, a fourplex, we click into that and we can download the package. And basically what it is, and I know it's small on the screen here, my friends, but you can download it. Maybe I can make this a little bit bigger. As I scroll down, it's a blueprint or a design for a fourplex unit that you could build. You take that to your local building department, your city, and for all intents and purposes, they'll rubber stamp it, providing zoning and all that other stuff. That's something else. But as for your architectural drawings, everything like that, this is going to get that rubber stamp approval, which is pretty cool. And I think if you're kind of first to market with this, you're going to provide some very great housing opportunities for people, and you're going to get yourself. I think this is a great opportunity, Dion. We've been asking for this for quite a while, right?
Yeah, and I mean, again, let's just call it what it is. This is one of the government's solutions to our ever-burdening housing crisis, which is how can we make small-time mom and dad developers or mom and dads into developers who then provide more housing per piece of land to Canadians and new Canadians. And yeah, I mean, the fact that you can fast track your development because, number one, a lot of the entire city of Toronto was upzoned to 4 units approved, as long as you have the space for it. And then if this particular drawing fits on your piece of land, then you can cut through a bunch of red tape and be, breaking ground on your construction way faster than most. So yeah, it's exciting. There's specialized financing on that as well, Gary, for people who are building these types of things. Certain construction loans that fit this model. I've dealt with a few of these at the smallest level. I've dealt with quite a few people who have built the what they call the ADU, the accessory dwelling unit, which is effectively a standalone unit behind their existing property. In most cases, behind their existing property, which then turns into a second or third unit. But this is taking it to 4 units, and I saw there a construction plan for a 6 unit as well.
Yeah, 6 units. So it's interesting. So we had the garden suite, if you will. all the way up to 6 units. Funny enough, if I go back into the designs and I choose the province of Ontario, what do we have here? We have the accessory units. That's that garden suite.
Right.
Then and then you can see the stacked townhouses and so forth. Fourplex, couple fourplex designs. We skip the fiveplex unit or fiveplex building because that's that unicorn for financing, if you will, always. And then you have your 6 unit building here. And I will mention this too. If we just click on any one of these, you have the main floor plans. You can click on them, and all of the plans also have the option for accessible units. So if you really want to stand out in the crowd or offer something slightly unique and different, having that accessible floor plan might be something that you want to look at as well. Because, like we said off the top, everybody needs housing and suitable housing, if you will. I should asterisk this: if you want to stay in touch with it and stay up to date with the highlights or the updates, obviously sign yourself up for that email. This is right from CMHC, and I had it back here on the previous page. But all the final drawings and packages will be made available the spring of this year. So very, very soon we'll start to see all of those packages released. It also is, and you might ask yourself, well, why is it? Why is it province specific? Well, every province has slightly different building code, and all of the buildings here, the designs are specific to that province. So you obviously has somewhat of the same layout, but very specific to the province that you want to build in. So make sure that you're tuned into that. Anyways, we just thought this was kind of cool to circle back to. We'll keep our ears to the ground on that. And if you want to reach out or see this website, just Google the Home Housing Design Catalog, CMHC, and it'll bring you to this website right here. And you can educate yourself, which is pretty cool.
Very cool.
Yeah, good stuff. Okay, my friends, we talked off the top, and we often ask Dion many, many different types of questions. And we thought we'd ask Dion kind of the 5 questions that perhaps not only he wish some of his clients would know, but sometimes if you don't know what to ask, you don't know what to ask, and that's okay. And maybe some of these questions help prompt and stimulate some of the things that you need to know. But we thought we'd ask Dion some questions here about a borrower looking to, either renew, refi, or they're looking to purchase a home. And Dion, the first question that we have for you today is, how does mortgage qualify under the mortgage stress test? How does my mortgage qualify under the mortgage stress test? Excuse me.
Sure. So several years ago, many years ago, let's just say you were going for an interest rate at a bank, and that interest rate was 3.5%. What they would do was they would calculate what that monthly payment would be and then compare that to your income. And they would test your income at what we call the contract rate. And the contract rate was 3.5. Then basically the government came out and said, you know what? Even though people are getting interest rates at that rate when they sign the contract, there's the possibility that that rate could increase. And so let's test them at an imaginary potential future rate. And that arbitrary number that they chose was 5.25%. So even though you were getting your mortgage at, say, 3%, they would test it at 5.25. Actually, this is where my example falls apart, because it's either 5.25% or 2% higher than your contract rate. So if your contract rate was 3.5, they'd actually test you at 5.5. So put simply, whatever contract rate you're signing for, you're getting tested at a higher rate for your safety. And again, Gary, when this first came out, you and I both said, oh, this is crazy. Why are they implementing this stress test? It's making it so hard for people to buy. And it turns out that stress test is what actually saved a bunch of Canadians during this increase in interest rates that happened in the years 22 and 23, 24. And so it actually did keep us safe. So it turned out that it was actually a good idea. The government did something correct, even though we sort of complained about it. And now the good news is, as rates are coming down, that stress test is where we're testing a lot of these closer to that 5.25% rate or much lower than it used to be. So when you're going for your mortgage, just know that the rate that you're testing it at, the rate that you're signing at is one thing that's going to translate to a monthly payment. Let's call that monthly payment $3,000. But they might, in fact, be testing your ability to pay $4,000. And so that's what that stress test is.
Excellent. Okay. Next question, my friends, is what are the prepayment privileges and how much can I pay annually? Pay down annually.
Okay,
Yeah.
great. So if I just go back to that example where, let's say, your payment's $3,000 a month, that's $36,000 a year. That's what your scheduled mortgage payments are. Okay. Now, on top of that, almost every lender will allow you to do extra payment on top of your minimum $36,000 a year. Let's say you've got a mortgage of $500,000. Okay. Uh, a simple one I can say is almost every major lender that works in the A lending space will allow you at least 10% prepayment. Some will allow you 20% prepayment of your original borrowing. So if you borrowed 500,000, your regular payments are 36 grand a year. They'll still allow you to pay 10% of the original borrowing. That's $50,000 more on top of your 36,000 without any penalty. That entire 50,000 of prepayment goes directly to reducing your principal, therefore dropping, say, from 500 grand to 450,000. Okay. So the prepayment allows you to pay off your mortgage faster. You can do this in lump sums, maybe once a month, once a quarter, once a year, or you can schedule it on a monthly basis. So let's say your monthly payment's 3,000 and you say, you know what, we can manage 3,200. And so every month you're paying an extra $200 a month. So that's the way that you can utilize your prepayments. I will give you a warning. There are some super cheap interest rates out there. And some of these super cheap interest rates do dramatically limit your prepayments. And so the warning is, it's almost like getting a mortgage is sometimes like getting a car. Sometimes they're cheap to get into, but very difficult to get out of in terms of, say, breaking a lease or something like that can be a pain. So when you're looking at the contract for your mortgage, make sure that the prepayments in there, or at least you understand and acknowledge the risks that come with these ultra low interest rates because they sometimes restrict those prepayments.
Yeah, I know that's good. And I know there are a handful of people that will take advantage of the prepayment privileges, and it will dramatically reduce the length or your term of the mortgage as well. So if that's something that's important to you, make sure that you look at that fine print and have Dion walk you through that, what that looks like. Because that for those that want to pay it off in a faster fashion, it's a great way to do that, Dion, right?
Yeah, I'll just say something interesting that happened this week, Gary. I had a client who needed to break their mortgage. And as you know, when you break your mortgage, you pay a penalty, right? You pay a penalty on the outstanding balance. So his outstanding balance was something like 500 grand, but he had a prepayment allowance of 50 grand. If he had 50 grand somewhere, he could pay down that mortgage from 500 to 450, and he'd only pay the penalty on the 450. So he'd save 10% on his penalty. What we realized is he actually had a home equity line of credit in addition to his 500 grand. So we actually borrowed money from the home equity line of credit, paid down his principal on his mortgage, and then broke his mortgage. So he effectively used the bank's own money against them to reduce his penalty. So if ever you're thinking about breaking a mortgage too, give me a call and I'll talk you through how to strategically save yourself some money.
There you go. And my friends, you only get insight like that when you start sharing and looking at your mortgage documents and the available money that you have to you. That deal, that's a great example. Good stuff. Okay, so almost in line with that question, but let's segue a little bit. What happens if I need to port my mortgage, or can I port my mortgage to a new home?
Okay, so in most cases, you can port your mortgage. As always, make sure that the particular mortgage that you are arranging or have, you have to read the fine print and make sure it's portable. Porting means that you are living in property number one, you're buying property number two, and you want to pick up the mortgage and drop it on the first property and drop it on the second property. Maybe because you have a really good low interest rate, and many of your clients are in that situation. Not for much longer because those really good interest rates sort of dried up a couple of years ago. But let's say you got a killer interest rate of 2%, and you want to sell and buy a new property. So you pick up this first mortgage from the first property. Let's say it's 400 grand. You drop it on the second property. But let's say that you need a mortgage for more than 400 grand. So you can take that first portion across, and you need another 300 on top of that. We can arrange that secondary portion of that 300 grand to kind of sit on top of the 400 grand. So that's how porting works. You port as much as you can, and then if you need more, you take more. If you need less, let's say you're porting it, but you only need 300 of the 400. Well, what happens is you break a little bit. You pay the penalty on the 100 grand that you give back, and you can port the that original that 300K. Something important to note: a lot of people think that if you're just taking the same mortgage from property one to property two, you don't have to requalify. You do, in fact, need to requalify. You will need to put forward your income and all of that if you are porting your mortgage. So they treat you like a new risk, even though you're obviously an older risk, but they're going to assess you again.
So I want you to read between the lines. First of all, no, Dion did not call you old. Or an old risk, but that's
I'm calling
important.
You an old risk, Gary.
Yeah, that's right. Yeah. It's important because not only they have to assess that risk once again, but they first approved you as to provide you with a mortgage. Not only you and your finances and your financial position, but also the house itself, in the location where it is, and perhaps the state of that home, and they have to walk or go through that process once again. Okay, moving on. How will this mortgage? This is important because we often don't think about this. We think about now and not the future. How will this mortgage affect my future borrowing power?
Okay, and when you say borrowing power here, Gary, is it as it relates to more real estate?
Yeah, let's look at it from that
Yep.
perspective.
Yeah. Okay. So, So let's say that you're buying a property today, and it's a pre-construction condo, right? And you've closed on it. Let's say you're living with your parents. You're living with your parents. You've bought this condo. You bought it for the purpose of investing. Okay, fantastic. You easily qualify. You don't have any debt. Let's say a couple of years down the line, you meet the love of your life, and the two of you want to go off and buy a house. Okay, fantastic. Now, the question is, does the fact that you own a condo impact your ability to buy that next property? So the answer is yes, but to what extent, we don't know. And when I say we don't know, it depends on, in this case, what is the monthly rental income and what is the monthly expense associated with that condo. And put simply, if the rental income is really much greater than the monthly expense, then that condo doesn't have a negative impact. It might be neutral, might in fact be positive if the cash flow is so good from that investment property. It might actually contribute to extra income that you can use on your application. On the flip side, if that condo is, say, a negative cash flow property, then yes, it will drag on your debt service ratio in the same way that, say, a car payment would negatively drag. So it could potentially have a negative impact. And in some cases, Gary, what we'll do in scenarios like this is, let's say, and this happens regularly, I've got a client, they've been told by their bank, there's no way you can keep your condo and buy that next house. That's the message from the bank. And what we will do is we'll look at that condo and we'll say, okay, well, what's the amortization on your mortgage? It might be 15 years. That payment might be $4,000. And if you work with us and we stretch that amortization, we could drop that payment to $2,500, giving you $1,500 back into your cash flow, which then allows you to keep the condo and buy the next property. So if you've been told no by somebody, just, I would say, get a second opinion, because we've helped many clients buy their second, third, fourth property when they were told that they couldn't buy anymore.
Excellent. And that's what I like about working with you, Dion. It's not necessarily always and only about this current purchase. It's about that next one and what does that look like. And it's important to have those conversations. And for some, there's not a next purchase, and that's quite all right. But just knowing how to have that conversation is incredibly important. So that's good stuff. Okay, lastly, And we kind of, this is kind of circling back to the stats and the information you shared earlier. Do you recommend a fixed or variable rate? And we already know what the answer is going to be because it's yes.
Yes, exactly. So I will tell you today, this morning, so it's now 2 p.m., 2:20 p.m., okay? This morning, I've had 3 conversations with clients about interest rates. 2 of them are taking the variable, 1 of them is taking the fixed, okay? And all of them know that the variable rate will likely go down. And so you might say, well, why did that third person choose a fixed and not a variable? And he said, Dion, listen, I'm a business owner. I just need predictability in this one part of my life because in other parts of my life with my business and cash flow, things are so unpredictable that I just need this thing locked down. I'm like, you know what? That makes total sense. And I said to him, if you take this fixed rate and rates drop, you got to promise yourself that you won't be kicking yourself when rates drop because they're going to. You know they're going to. And he's like, yeah, I'm at peace with that decision. So you know what? It's not always about rate, and pennies. It's about sort of how it sets you mentally, so you can deal with other stuff in your life sometimes.
Yeah, there you go. And it is very specific to you as a borrower. And we know, as Dion, you just said, rates are going down. So if that's in your best interest, variable rate might be the option. And you can always lock that in during that mortgage term, or for the most part, you can, correct?
Correct. Yeah. So that is called conversion. So if you take a variable rate and in 1 month or 3 years from now, you say, you know what, I would now like to change this over to a fixed rate, you can. Technically, it's not called a switch. That's a different thing in the world of mortgages. It's called a conversion. Okay. And if you are going to do that, again, I would say reach out to a mortgage brokerage and ask them, hey, is now the time to convert over to a fixed? And just know that if you stay with the same lender, there's zero cost for converting from a variable to a fixed.
There you have it, my friends. Okay, Dion, lots of great stuff happening on the video today and great information shared. Remind us how to get a hold of you.
Yeah, at kangamortgage.ca or Instagram at the Dion Begg.
There you have it. That is the Dion Begg. I'm Gary McGowan. We'll see everybody in the next video. Goodbye for now.